Howdy, Jacob here. Today we're looking at Vinci Partners Investments, ticker symbol VINP. Is in the capital markets industry. 547 million market cap, 331 enterprise value. So net debt is positive in cash and investments. We see that they have about 31 million in long-term debt, 257 million in short-term investments, and then 6 million in cash and cash equivalents. So a good amount of uh, good-looking balance sheet where they have a lot more liquid assets than their total debts, which is great to see. We see that growth has been interesting, 46 million in 2018 to 96 million in 2022. So it looks a little small. Return on invested capital looks absolutely humongous. And when were they founded? So founded in 2009 in Brazil. Okay. Let's look at percent of insider ownership. We see 6.6% dividend yield, 33% held by insiders. So that's good to see. Means that hopefully they're making or there's a higher likelihood the board is making good decision. The management and board are making good decisions that are in the best interest of the shareholder. Pretty good cash flow, but this dividend, 40 million payout and a 5-year average cash of probably 30, no more than 30 million. And so that dividend is absolutely going to be cut. And I mean, capital market industries are interesting where they can show huge return on invested capital when in reality um, their access to invest in certain things at that type of capital is kind of restricted. And I've seen that in T Row, Invesco, those types of businesses where return on invested capital can look massive, but again, their investment opportunities can be limited. And so, um, yeah, that dividend is too high in comparison to their 5-year average free cash flow. I'm definitely going to cut that down. Let's say I might cut it third, cut it 67% because I want them to have the opportunity to buy back extremely cheap shares if they want, make acquisitions if they want. So I'd prefer this payout to be 30 to 40%, which is where it would be if I cut it 67%. That would cut their dividend down to a little over 2%. So if you're just looking for a dividend, just already Ixnay. But if you're looking for a little bit of dividend that's still above the market and possible return, let's start making some assumptions here. So as for growth, investment, capital market business, it's very small. I mean, it's going to look like these numbers are really small, but over the next 7 years, we might have a little bit of turmoil market. Obviously, this is in Brazil, and I'm less confident in what the market looks like in Brazil right now. Looks like they cover private equity, infrastructure, real estate, credit, public equities, and all in between. So until I do a deeper dive, I'm going to be comfortable with these assumptions at a high level to be pretty conservative. As for margins, I mean, they don't have much debt, so I'll probably do essentially average with a little bit of a range here. No share change. And then with these current assumptions, we get to a stock price that needs to fall about 35% before you get a 50% return given these assumptions. Again, this is extremely preliminary. I don't know too much about the Brazilian investment market, and so these assumptions are absolutely preliminary. But my best guess with just looking at the numbers for a couple minutes, and I think that as for a dividend goes, they're probably going to have to cut it, or they'll very likely have to cut it unless they're going to charge more into debt. A 40 million payout and a 5-year average free cash flow of 30 million is not going to be a long-term path. But even if they cut it, I think it still has a good chance of being greater than the greater dividend yield in the market. And so, yeah, I hope everyone enjoyed the video as great as today.